Everyone, today we're going to be talking about generating consistent income in your portfolio using options. Today we're going to be covering a variety of topics. Number one, what we really want to do is show you guys what are the best practices and methodologies so that you can generate consistent income using the stocks that you already own in your portfolio. But the most important thing that I want to make sure that everyone here walks away with today is having the knowledge that, or feeling confident that you have the tools in order to implement everything that we're teaching you today. The most important piece is that we're going to show you how to actually take what we're showing you today and all the different methods for generating income, but using the OptionsPlay platform so that you can instantly find these strategies and add them to your portfolio right after we finish our webinar today. That's really the goal, and I hope you guys find this useful. I'm going to leave this audio thing up for just 1 second for those who are joining late. If you have any audio issues, please dial into that conference line if you can't hear me. So, like I said today, we're going to cover some of the basics of cover calls because that's the strategy we're going to be talking about. But for those of you that are a bit more advanced, you can take the same concepts that we're teaching today and use them for short puts. And we'll go over both the cover call and the short put side. So regardless of whether you own the stock and you want to generate some income or you want to own the stock, there are both ways that you can generate some income by either selling cover calls or short puts. But the most important part about doing these types of strategies for your portfolio is understanding what your individual profiles look like, because that will help you drive what is the correct income strategy that fits your portfolio. So we're going to help you identify what those individual profiles are and show you how you can apply them on OptionsPlay so that the strategies that we find for you are based on your own personal preferences. Next, we're going to cover some of the best practices and results of these types of strategies, what you can expect, what are the different methodologies to get the best returns out of these types of strategies. And lastly, like I said, the most important part is showing you how to actually do it using OptionsPlay. So we're going to show you how to automate your cover calls using OptionsPlay on the actual platform. We'll go through some real-life examples of what are strategies that work, what are strategies that don't work, so that you can very quickly identify when you have a good strategy for your portfolio. And lastly, once you're in these strategies, the number one question that I typically get asked is, how do you manage these trades? And we'll talk about some of those exit strategies, how to manage these trades once you're in them. So I'm just going to go ahead and jump right into it. Before I get started, for those of you that are new to this type of strategy, cover calls and short puts, if you're new to this, type yes into the chat window, just so I get an idea as far as who's on this webinar. I just want to know who here is new to these types of strategies, and type in no if you have traded these strategies, meaning you have either done cover calls or short puts. Just type in yes or no into the chat window. Okay, I got a bunch of yeses, a few nos. Great. Okay, so it sounds like a lot of you guys are relatively new to this strategy, so I'll cover some of the basics and benefits of these types of strategies, and then we'll get into kind of the best practices and how to apply them to your portfolio. So number one, whether you're selling cover calls or short puts, these benefits will apply. Number one, it generates consistent income in your portfolio, because when you're selling options, once those options expire, you can go in and sell another one. And that's what generates that consistency of income month after month, quarter after quarter. Regardless of how often you sell these calls, you will be able to take advantage of these options to generate income for your portfolio. And what that does is it lowers the volatility and the net cost basis of your portfolio. This is exactly why these income strategies are useful, because not only does it generate income, it lowers the net volatility of your portfolio. And the best thing is that it's used on stocks in your current portfolio. So if you have shares that you currently already own in your portfolio, or a stock that you want to own in your portfolio, these are strategies that you would use on those stocks that you're either watching or that you already own in your portfolio. There are some limitations to these types of strategies, and this is more so for covered calls. It does limit the upside return of your stock, and that's a very important thing to understand, and we'll talk about why, because it will help you determine what is the appropriate strike price to sell when you're doing these covered calls. It's extremely important to understand how much you're limiting your stock, the ability for your stock to continue going higher. It does require at least 100 shares of the underlying stock in order for you to sell a covered call. So many of you may have some positions or some stocks where you have less than 100 shares, so this is not a strategy that you can deploy for those positions. And lastly, you do risk losing that stock, which does potentially become a taxable event if this is done in a tax account. So those are some of the limitations for these types of strategies. And what we'll do is we'll jump right into what are the different preferences that you'll have to identify before you can add these types of strategies to your portfolio. So number one, when it comes to selling covered calls, there's really only two things that you need to identify. And this applies to short puts as well. Number one is how far out, or what is your expiration date that you want to choose, and what strike price will you choose. And how do you pick an expiration and strike price is really contingent upon your personal preferences, okay? So for me, myself, I'm a fairly active trader. I have the ability to look at my account almost on a daily basis and stay on top of my portfolio. So I myself fall under more of the shorter end of the spectrum when it comes to time frame. I typically trade relatively short dated options because I have that ability to look at my account on a fairly frequent basis. So I would typically choose expirations that's a few weeks out to about 2 months out maximum. I usually don't go further out than 2 months because I'm a short-term trader. So and conversely, if you're a long-term trader, maybe you're the type of investor that buys a stock and holds on to it for years, and you might only be able to look at your account once a month or once a quarter, you would fall under the long-term time frame. So you would typically sell covered calls or short puts that are either 3 to 6 months out, somewhere in that range, because you're only looking at your account once a month or once a quarter. You may not be able to do trades as frequently as I do. You want to sell longer dated calls. Lastly, many of you will probably fall somewhere in between. You may not have time to take a look at your account every day, but you probably look at it once a week, once every couple of weeks. You generally want to sell covered calls that's anywhere from 2 to 3 months out. Now, you don't have to memorize these expiration dates because OptionsPlay already does all of this work for you. You just have to remember, which one do I fall under? Are you a short, medium, or long-term type of trader? Again, just for myself, as a short-term trader, so before you go on, let's make a mental note to yourself. Do you fall into the short, medium, or long-term? Because that's going to go into the settings that you put into OptionsPlay. Next, when it comes to choosing a strike price, this is really contingent upon your risk tolerance, and each one of us will have different risk tolerances. So it's important to understand where you fit on that spectrum. So for those of you that are conservative, and what I mean by that is if you have stock that you've held onto for a long time, either it's stock that you maybe have owned for years and you have a very low cost basis, or perhaps this is a stock that you rely on the dividend for income, you would typically fall under the conservative end of the spectrum. What that means is that you don't typically want to lose that stock because this is a stock that you want to continue holding on to for the long term, or you don't want to lose that stock because you don't want to lose those dividends. You have a conservative risk tolerance. You don't want to lose your stock when you're selling covered calls. So if that's the case, you want to find strike prices that are approximately a 90% chance that that call will expire worthless. For those of you that have traded options before, you may not be familiar with a probability of expiring worthless, but you may have heard of a term called delta. Delta is usually used as a way to approximate what is the probability of that call being in the money. So a 90% probability of expiring worthless equates to a 10 delta call. Again, you don't have to memorize this. You just have to remember which risk tolerance you are, because OptionsPlay will do that work for you. But I do have this data in front of you just to give you a reference point in how to select your strike prices if you were ever able to do this manually, or just so reference purposes, so you know how we go about selecting the appropriate strikes for yourself. So we talked about someone who's conservative, meaning someone who has stock that they really don't want to lose. They want to hang on to it as their main objective. They would fall under the conservative end of the spectrum. Conversely, on the other end of the spectrum, for those of you that are really aggressive when it comes to your risk tolerance, you're really wanting to chase as much yield as possible. This is typically someone who's a little younger, who doesn't have a lot of stock, or stock they've held on to for a long time. They don't mind losing it in exchange for some higher yield. They would fall under the aggressive end of the spectrum when it comes to risk tolerance. So for those users, you would typically select a call that has approximately a 70% chance of that call expiring worthless, or approximately a 30 delta call. And then most of you will probably fall somewhere in between, just like myself. I fall under the optimal end of the spectrum. I'm not too conservative, I'm not too aggressive. I'm really seeking a nice balance between risk and reward. So then I would choose usually about a call that has approximately an 80% chance of expiring worthless, or about a 20 delta call. So again, you don't have to memorize, what expiration dates and what deltas you need to choose, because OptionsPlay will actually do that work for you. You just have to remember, where do you fall under short, medium, and long term, and conservative, optimal, or aggressive. So myself, I fall under the short term of optimal track, right? So just make a mental note to yourself, where do you fall under in terms of time frame, where do you fall under in terms of risk tolerance, and we'll show you how you can plug that into OptionsPlay so that you can find the appropriate income strategies that fits your personal preferences every single time using OptionsPlay. So let's talk about now that we've gone through this, how do you generate consistent income in your portfolio month after month, quarter after quarter? And the answer to that is actually really, really simple. It's really two things. Number one, selecting an expiration date that suits your trading frequency. So talking about, if you're a short-term trader, choosing shorter dated options. If you're a conservative trader, choosing conservative strike prices. Just basically staying with your preferences when it comes to expiration and strike selection. So using the expiration date that suits your trading frequency and selecting a strike price that has a probability that fits your risk tolerance. So that's the most important piece, is making sure that you stay in your lane when it comes to selecting the right expiration and strike prices, because that's how you gain consistency. If you do short-term optimal calls this month and then next month you do long-term aggressive calls, you're going to get inconsistent results. You want to stick with that short-term optimal if that's your track every single month, month after month, on every single stock. That's how you're going to be able to gain consistency in your account. The other piece is, once you've found the cover call based on, or a short put based on these preferences, the question you then still have to ask yourself is, am I getting enough yield on that call to justify the risk that I'm taking? So when you're selling a cover call, that risk is you losing that stock at that strike price. Are you okay with that risk of doing that? And the question becomes, am I getting enough yield to take on that risk? And a lot of times, a lot of users have a difficulty in determining whether or not they're getting enough yield. Some people like to get a minimum of 25 cents or 30 cents or a certain dollar amount, but the best thing to use is actually the yield on the cover call to determine, am I getting enough return, am I getting enough yield in order to take this type of risk? And I usually tell users to use your dividend yield as your guide, right? Because if you own the stock today, or if you want to own the stock, the dividend yield gives you an idea as far as how much yield you're going to get if you own that stock. So if you're going to sell a cover call, meaning you're going to try to add yield to your account, to your position, you usually want to at least beat the dividend yield on that cover call in order for it to be worth your while. And what I'll do is I'll show you some real life examples of where you have a cover call that does beat the dividend yield, and there's cover calls that don't beat the dividend yield. And you can see very clearly how OptionsPlay makes it very easy for you to determine, number one, where is the correct expiration and strike price, and am I getting enough yield on this trade in order for it to be worth my while? So I do want to share with you some of the back testing and some of the data that we've looked at. Going over the past 10 years, looking at all the different cover calls that people have sold, we've back tested different expiration dates, different strike prices, and we just want to share with you some of our findings because it does help you kind of shape where you might want to consider selling your cover calls. So number one, what we did is we looked at the different types of expirations. We looked at short-dated calls, medium long-dated calls, long-dated calls, and we tried selling all of these different types of calls and seeing which ones perform best in the long run. So when you're doing short dated calls, what you get is you get less premium because shorter dated calls will always yield less premium than a longer dated call, which will give you more premium. But just like all trading, there's a trade-off between that less and more premium, and that trade-off is certainty. What do I mean by that? When you're selling a short dated call, let's say you're selling a 1-month call, there's relatively more certainty you have as to what's going to happen in the next 1 month versus if you were to sell a 3-month call, because there's a lot more things that can potentially happen between now and 3 months than in just the next month. Things like earnings date, dividends, product launches, things like that. Those things will typically have some visibility. You'll know if something's coming up in the next month. It's a little harder to predict those things over the next 3 months. So what you're trading off with that more premium is less certainty. So the question becomes, which one's best, or where is the most optimal time frame? And from our findings, the best timing is actually more on the shorter end of the spectrum. And the reason for this is actually because of earnings. Now, in the US and Canada, we have earnings that report 4 times a year. So what that means is that if you're selling 1-month calls, that means you can sell 12 of those in 1 year, then 4 out of those 12 calls that you sell have this large uncertainty factor built into it, because earnings is the largest driver of price instability on a stock in the US and Canada. So what we generally want to do is avoid this type of uncertainty, because there's a lot of things that can happen. The stock can shoot up, it can shoot down, and it creates a lot of uncertainty into where the stock's going to be. So when you're selling 1-month calls, only 25% of the calls that you sell have this large uncertainty factor built into it. 75% of the calls that you sell are fairly predictable, meaning stocks are, generally speaking, they don't generally have a lot of gaps outside of those earnings cycles. So you have a little bit more certainty in 75% of the calls that you sell. Conversely, if you were to do long-dated calls, there's nothing wrong with that, but if you do long-dated calls, let's say you sell a 3-month call, you can only do those 4 times a year. And since there's earnings 4 times a year, then 100% of the calls that you sell have this large uncertainty factor built into it because of earnings. So that's why it is, based on our backtesting, it's better to do short-dated calls more often, and have the majority of the trades that you sell have more certainty than to have most of your trades have this large uncertainty factor built into it, because that's really the largest driver of underperforming types of strategies. So based on our research, it's better to lean more on the shorter dated side if you have the ability to look at your account more often, or trade short dated calls like 1-month calls. It's definitely preferential to do that compared to doing longer dated calls based on our research. Next, we want to look at the different strike prices. So if you were to sell conservative calls, optimal calls, aggressive calls, where you're going to get the biggest performance. And so when you're selling conservative calls, like we said, for those of you that don't want to lose your stock, your main objective is keeping your stock, you're going to be selling conservative calls. And for that, you're going to get less premium for that. If you were to sell very aggressive calls, you're going to get more premium for that. And what's the trade-off that you get is how much upside you give your stock. Okay, so if you sell a conservative call, you're giving your stock a lot of room to still go higher before that stock gets called away. If you're selling a very aggressive call, you're definitely going to get more premium for it, but you have a lot less upside for that stock to continue going higher before it gets called away. So based on our research, what we look at is all of these different trades across hundreds of different stocks, and we wanted to see what's best, what gives you the highest performance in the long run. And the answer to that is actually to be on the more conservative end of the spectrum, taking in less premium, but giving your stock that upside chance to move higher. Because the worst thing about selling covered calls is if you sell a call and the stock shoots significantly higher and you're not participating in any part of that because you were trying to chase an extra 30, 40 cents on that covered call just to get a little bit more premium, and then giving up $3, $4 in exchange for that. So that's why that negative risk reward on this covered call is not great. So it's best to actually give your stock a little bit more upside, take in less premium, because you want to give that stock the ability to continue going higher when it does run higher. That can happen on earnings, that can happen on news, whatever the event is. We see this happen over and over again, where just to try to get a little bit more extra premium by getting super aggressive is most of the time not worth it because you're giving up a lot more of it when the stock shoots above that strike price. So just to kind of summarize what we just talked about, I did go over a lot of data. Number one, we talk about what is the optimal cover call strike, and really what we want to do is prioritize certainty over premium and prioritize giving your stock upside return over getting some fat premiums in the short run. That will give you better returns or higher returns in the long run if you stick to these types of strategies. You generally want to have expirations that are more in the shorter term, about 20 to 45 days out, and strike prices that are around 15 delta, which is right in between that optimal and conservative track. So whether you're conservative or optimal, you'll be straddling just around that optimal strike price based on our back test. And lastly, the type of performance that we see with these types of strategies on average out to be about a little over 3% per year on top of the gains that you were getting on your underlying stock or your underlying portfolio. So you're expecting roughly on average about 3% higher above your current rates by adding cover call type strategies to your portfolio. So with that, what I really want to get into today is not talk about all these things, but actually show you how to do it. So with that, I'm just going to jump right into OptionsPlay. For those of you that have this platform, and I believe every one of you have signed up for this, that's why you got invited to this webinar, you have access to this free of charge through the Toronto-Montreal Exchange. I highly recommend for those of you that haven't logged on to get yourself on there because we're going to show you how to do this using our platform instantly. Even if you've never traded an option, if you've never looked at an option before, we're going to show you how you can generate some income on your individual portfolio, either in stocks that you own or stocks that you want to own. So what I have here in front of me is the OptionsPlay platform. As you can see, I have three panels. I have trade ideas and watch lists here on the left. I have the equity analytics panel here in the middle, and then I have trading and income here on the right. So this platform is designed for all types of traders, not just users who are looking for income. So we have trade ideas here. So these are fresh, bullish, and bearish ideas scanned for you every single day. We have underlying analytics for the underlying stock. So you can see things like what are the current trends of the stock, what is the relative strength of the stock. We have a lot of interesting information, useful information, such as earnings and dividends, when that next earnings date is, when the next dividend is going to be paid. Current price action is what's currently going on with that stock, as well as support and resistance levels, so you can see where that next support or resistance level on this particular stock is. And once you have a view on this stock, we'll show you how you can take advantage of this. Whether you're bullish on this stock, we'll show you 3 bullish strategies. If you're bearish on the stock, we'll show you 3 bearish strategies. So especially if you're new to options trading and you're not sure what is the best option strategy to pick, you should come here because it will help you get to a good starting point as opposed to you having to figure that out by looking at an option chain. A lot of times when you're staring at that chain, there's so many different calls and puts that you can choose from, so many different expirations, you tend to get overwhelmed with what to do. So this platform is designed to kind of take away from that experience and show you just a few examples of what you can do, either whether you're bullish, bearish, or looking for income. So today we're going to focus more on the income side because this is what most of you are looking for in your portfolios. So when you type in any symbol and you click on the income tab, what we present to you is 2 strategies, cover call and short put. For those of you that are new to option strategies, I would suggest that you take a look at cover calls. For those of you that are a bit more advanced or looking to leverage this for stocks that you don't already own but you want to own, short puts is another way to do so. We'll talk about cover calls and short puts, but I'm going to spend most of my time on the cover call side. So before we get started, remember when we talked about on the PowerPoint, number 1 is choosing your personal preferences. Like I said, mine was short-term optimal. Make a mental note to yourself where you fall under, because when you first start off with OptionsPlay, you click on the button here in the bottom that says default settings. And what that allows you to do is actually create these settings, and you can choose your own settings. Like I said, mine was short-term optimal. So for calls, I like to choose short-term because that's the time frame that suits me. And for risk tolerance, I choose optimal because that's the risk tolerance that suits me. You can set these independently for calls and puts. So for example, for puts, I like to be a bit more aggressive when I sell my puts, so I choose short-term aggressive for my puts. And you can set these independently of each other. So a lot of people tend to do this where they're more aggressive on one strategy than the other, or they like to do different time frames. But for the most part, most people choose the same time frame, but they may choose different risk tolerances depending on the strategy. And all you have to do is save as default. Once you do that, all the symbols that you type in, so let's take a look at my buy right watch list here. For any symbol that you click on, so for example, let's look at BMO. This is a stock that a lot of you may own in your portfolios. What OptionsPlay goes out and does so that you don't have to pull up that chain, search for the 30-day option, search for the 20 delta call, then check the yield on that, check the premium, and all these things that you have to do, OptionsPlay does all that work for you. So what it does is it actually goes out through the chain and looks for short optimal calls that you can sell against BMO stock that you have. So as you can see here on top, it says, do you own shares of BMO? If you do, you type in yes, then you enter in the number of shares that you own. So let's say you own 300 shares of BMO, and it instantly tells you that you can sell 3 contracts of the November 3rd, 98.5 cover calls. So BMO is trading at 96.80. So these are calls that are trading approximately $2 out of the money. And remember what we said, choosing an expiration and strike price based on your preferences. So this is already doing that for you. It's telling you to look at the November 3rd, 98.5 cover calls. And the last thing we talked about in terms of generating consistent income is checking your dividend yield against the yield of the cover call. So what this does is it breaks all of that down for you so that you don't have to go and calculate it. You don't have to go searching for it. It tells you the annualized return on this cover call is 3.93%. This is a stock that currently pays a 3.7% dividend yield. So just by selling these cover calls on top of my stock, I'm increasing my total 12-month projected yield to about 7.6%. So I'm effectively doubling my yield by adding this type of strategy to my account. So based on all the things that we talked about, I was able to find a short-dated call. So as you can see, this is 24 days from expiration, which suits my personal preferences in terms of short term. It found me a cover call that has approximately a 71% probability of expiring worthless, somewhat in the range that I was looking for, and it gives me enough yield to overcome the dividend that I'm currently getting on this particular stock. So this is certainly a trade that I might consider taking, right? So, and this is all without having to do any additional work. You just have to plug in the name of your stock, the number of shares that you own, and it instantly tells you which call is a good starting point for you so that you don't have to go searching for it. And then it provides all the analytics. So if you're new to this, it'll explain that selling the November 3rd, 98.5 calls will generate $75 in premium. That produces approximately a 4% annualized return, and there's a 71% chance that this call is going to expire worthless. Now, if you're completely new to trading, I highly recommend before you place any trades in your brokerage firm, click on the trade button, because what we'd have is what's called a strategy checklist. This is checking your trade against a few different things that a lot of times if you're a beginner, you might tend to overlook. And we created this because as traders, a lot of times when we're looking at options, we have to look at so many different things before we place a trade. It's really easy to forget some of the simple stuff. So what we wanted to do is create a checklist so that you go through all the simple stuff before you place a trade. And especially if you're new to trading, these might not even be things that you knew to look out for. So one of the things we check for is the probability of expiring worthless. In this particular case, it's slightly lower than optimal based on my settings. So this is the decision that I have to make. Am I getting enough yield for this, right? This is telling me that it has 3.93% annualized return, which is average. That's okay for me. I'm okay with average. It's checking if there's earnings between now and expiration. It's telling me there isn't, which is very important. And lastly, it looks at spread and liquidity. So it tells me that the spread of the bid-ask is sizable, and it recommends me to place a limit order near the mid price. So these are all things that I look for before I place a trade. And if you're new to this, you might say, not everything here quite lines up exactly the way I want. Maybe it's not for me, but this is helping you make a decision as to whether this is a trade that you should make. So with that, I'm just going to go through a few more examples so I can show you what this means. Let's look at Canadian Imperial. This is another fairly common Canadian stock. It's trading at 111. Like I said, you just have to type in the number of shares you own. So let's say you own 200 shares of Canadian Imperial. And it tells me immediately I should sell the November 17th, 115 cover calls. So the stock's trading at 111.50. This is telling me to sell the 115, so this is about $3.50 out of the money. This stock, this stock pays a 4.6% dividend yield, which is pretty high. And if you look at this cover call here, it only yields a 3.5% dividend, 3.5% yield on the cover call. So this is where an example where I'm not quite getting this quite enough yield, in my opinion, in order for this to be worth my while. So this is a personal decision that you have to make in terms of whether 3.5% is enough yield for you on a stock that already yields 4.6%. For myself, I think that this may be a little bit on the lower end when it comes to selling a cover call. So maybe on this particular case, I just might move on. Keep in mind that this platform is not only designed to help you quickly identify when there is an opportunity, but more importantly, it's helping you identify when the opportunity is not as good. It's helping you prevent you from making bad trades. Okay, and we're going to go through some more examples, and I'll show you this very quickly, what I mean by that. Let's look at Canadian Pacific, another fairly popular stock. Trading at 206.39, it's telling me that I should sell the November 17th 215 cover calls. So this is about $9 out of the money. As you can see, this stock only pays a 1% dividend yield, so it's not a very high yielding stock. And this cover call gives me a 6.5% yield. So I'm able to increase my yield from a little over 1% to a total yield of about 7%. This is a more attractive trade to be making. This is a trade that expires in 38 days. It yields a 6.5% yield, which is certainly attractive. And if I hit the trade button, as you can see, I get a much different picture, right? It has a good probability of expiring worthless. My optimal track is we're shooting for about an 80% chance of expiring worthless, so 77 is very close to that. It's giving me a 6.5% annualized return, which is very good, pretty high for a cover call. There is earnings between now and expiration. That's something I have to be aware of, that earnings is in about 7 days from now. And lastly, the spread and liquidity on this particular trade is actually very good. So I can place a trade near the bid-ask price and be comfortable in the fills that I get for that. So these are all the things that you want to look out for before you go ahead and place a trade. And this is all designed so that you can quickly go through a list of stocks within a few seconds, know exactly which stocks have cover call opportunities, which ones don't. So when I click on Royal Bank of Canada, as you can see, I get a slightly different message. Instead of that green check mark that we're used to seeing, I get this red warning sign. And this is, again, designed to not only help you find the right trade, but help you avoid bad ones. So here, Royal Bank of Canada is trading at 98.33. This is telling me that it could not find me a short-term optimal call, that it's displaying to me the next best alternative, which in this case is short-term aggressive. So it's telling me to get more aggressive because that's the best thing it's able to show me. So especially if you're new, these are the ones that you want to avoid. Okay, this means that we've searched all the chains. We couldn't find you anything that meets your criteria exactly. So we'll find you the next best alternative. But if you're new to this, I recommend that you simply just walk away. It just means that Royal Bank of Canada is not a good stock for you to sell cover calls on today. You could come back a few days from now and see if there's a new cover call that might suit you. But generally speaking, if you're new to these types of strategies, simply walk away. You don't have to do any more work. This is designed to save you time. I forgot if we looked at TD or not, but I guess not. So this is the same thing on TD. The stock trades at $71. It's telling me that instead of finding me a short-term optimal, the next best alternative found me was a medium-term optimal. So this is going out 66 days. So this is a little further out than I typically am comfortable doing. So this is, again, designed to help me save time so that I'm not wasting time going through the chains, trying to find a cover call that meets my criteria for TD. I simply see this message and I move on. MG, the stock's trading at 69.13, telling me that I should sell the November 17th 74 cover calls. Gives me all the underlying analytics. The stock pays a 2% dividend. This cover call in particular gives me a 4.3% yield, which brings my total yield to 6.3%. Certainly quite attractive in my personal opinion. So I would hit trade, look at the strategy checklist. As I can see, there is earnings coming up, and the spread and liquidity is relatively high, but this might be a trade that I still want to make. depending on your personal preferences when it comes to trading. So again, when you have I recommend all of you that are doing these types of strategies to create a watch list with all the stocks you either own in your account or want to own, because you can just click on it and within a few seconds know exactly if there's a cover call or an income opportunity for you on this particular stock. On ABX, looks like there isn't. I'm going to move on. DGC, there is, so this is something that I might analyze and take a look at and decide if this is something I want. DGC pays a 0% dividend, certainly not. If you hold on to the stock, you're getting no yield. Look at this covered call. This gives you a 13% annualized return on this covered call. So certainly something that you might want to consider taking a look at. This obviously is a very volatile stock. That's why you're getting such high premiums on it. So that's a decision you have to make as to whether or not that's enough yield for you. But as you can see, you're selling a $17 call on a $14 stock in just 38 days. So you have to ask yourself, do I think the stock's going to rally, $2.50 in the next 38 days? If you don't think so, this is certainly a call that you can add to your portfolio and generate an additional 13% yield. ENB, same thing. Couldn't exactly find me a cover call that I want, so I'll probably move on. TRP was able to find me something. Again, this is just designed to show you how quickly you can go through a list of stocks that you own and know exactly which opportunities have income opportunities and which ones don't, so that you don't waste time. That's the whole philosophy behind our platform. Is we want to help you get to a starting point and help you make a decision within a few seconds, so that you don't have to go searching for these things and spend 10 minutes just to find a covered call. We really want to be able to provide all that information to you at your fingertips. And just to kind of briefly go over for those of you that are selling short puts. So let's say Royal Bank of Canada is a stock that you want to own, but you don't currently own it. One strategy that you can do as an alternative to owning the stock or buying the stock outright is selling a put, because what that allows you to do is buy that stock at this predetermined price of the strike price. So if you sell the November 3rd 96.5 put, what that means is that on November 3rd, the stock is below 96.5, you now own that stock at 96.5. And in exchange for that, you're going to receive $61 in income for selling this put, which generates a 9% annualized return on a stock that only pays a 3% dividend. So this is certainly a trade that you might want to consider if you want to own the stock. This is one of my favorite strategies as an alternative to just outright buying the stock at the current price, especially if you feel that the current price is a little rich and you want to generate some income while potentially buying that stock at a lower price. It's one of my favorite ways to dollar cost average into a trade at a price that I'm comfortable doing. So for those of you that are a bit more advanced, that are trading stocks and you're looking for trades, definitely a strategy that you might want to consider adding to your portfolio as an alternative to acquiring the stock outright. So with that, I'm just going to go back to the PowerPoint slide real quick. Like I said, we're going to cover some of the exit strategies or the scenarios as to what to do once you're in these types of strategies. This is for the cover calls, but you can use these for short puts as well. And this will give you an idea as far as how to manage these trades once you're in a cover call. And there's three main scenarios that you need to account for. Number one, what happens if you sell a covered call and the stock shoots higher? What happens if the stock goes sideways? And what happens if the stock goes lower? So number one, when the stock shoots higher, this is usually when people tend to panic because they see there's a large unrealized loss on the short call that they have, and they don't know what to do. Again, the best thing to do in this particular case is actually to not panic and hold on to your covered call, and only roll that covered call if you need to within the last week. The reason for this is if you simply buy back your call because the stock shoots higher, what you're effectively doing is you're locking in a loss. And you're not capturing the time decay that you're really trying to capture when you're selling a cover call. Again, the best thing to do is don't panic. If the stock shoots above your strike price, you want to give that stock the opportunity to potentially fall back below that strike, still for you to capture that premium. The only way to do that is if you hang on to that cover call. If you absolutely need to roll, wait till the last week before expiration, then roll your cover call. The other thing is, if the stock really does take off significantly, if that call that you're selling reaches about a 90 delta call, that is a good opportunity to potentially just exit that trade at a loss, take that loss, because that means something significant may have changed with that stock, and you may want to get out of that short call and just hang on to that long stock position that you have. Next, what happens if the stock moves sideways? This is kind of your best case scenario when you're selling a cover call. This is, you sell a cover call at a 105 strike, and maybe the stock's trading at 100, and the stock just trades sideways. This is the best case scenario. You simply just hang on to your position, hold it until expiration, don't buy it back, let it expire worthless, and then come back the following Monday and sell another cover call. Lastly, this is another scenario that you don't necessarily want to be in, but if, let's say, you sell a cover call and the stock drops and you're losing money on the underlying stock, this is one of the few opportunities where you do want to roll early. You want to roll down your position as well. And what this does is it allows you to take profit or lock in a profit on the short call and potentially sell another call to generate some additional yield faster than you originally anticipated. And the key to doing this and determining when to roll early is if you can buy back the call that you've sold for less than 20% of the original premium that you got. So what that means is that if you sold a call for $1 and now it's trading at 20 cents or lower, you can buy it back and try to sell another call immediately, because now you've locked in 80 cents in profit and you can sell another call maybe for another $1. This is what we call hitting doubles and potentially triples between now and expiration, because now you're able to not only capture $1 over 30 days, you might be able to capture $1.50, $1.70 over that same 30 days when the stock does drop, and you're able to buy back that call for less than 20% of the original premium. So those are the three main scenarios and how you can handle them. So with that wraps up what I want to talk about. So at this point, what I'll do is I'll open this up to Q&A. If you have any questions regarding anything that I went over, or if you have a specific stock that you want to look at, type that into the chat window, and I'm happy to entertain any questions or stocks that you want to take a look at. I have one person asking for UNS. So I don't know what your personal preferences are here, but so I'm going to assume that you have similar preferences to mine. UNS is trading at $28. This is telling me for a short-term optimal, at least for myself, this is saying that if I own at least 100 shares, I should be selling the November 17th 30 cover calls. This is the stock that currently pays a 1.5% dividend yield, not very high, and you can see this cover call here is about an 8.5% yield. So that increases your total yield for holding the stock currently from about a little over 1% to roughly close to 10%. So this is an extremely attractive potential cover call opportunity here on this particular trade. The only thing I want to keep your eye out for is that the spread on this trade is very large. So if you can see, this option trades at 25 cents by 35 cents, which from a percentage standpoint is quite large. So you want to be careful where you place your order. Our recommendation is to put that order close to around 30 cents. So you're minimizing the impact of a spread on your trade itself. Otherwise, everything looks pretty good. This thing does have earnings in 16 days, so be aware of that. But this certainly does look like a potential opportunity. Thank you for that symbol for us to take a look at. I have one other question. Does OptionsPlay suggest collar trades? Sure, absolutely. So one of the things you do on the trading side, so we have on the trading side, this is where we have all the other strategies. So if you want to modify a trade, what we have is a strategy constructor, and you can select a collar from here. Let's go and find that collar. That short collar, where's the long collar? There we go. And this can allow you to set up a collar so that you can collar a stock. You can buy, put, sell a call, and do that all from this trade. Then you can set that up under the trading tab. It's a little different than what we're covering today. So this is a bit more advanced strategies. I'm not going to get into that, but we will have a separate webinar specifically on these types of trading strategies in a couple of weeks. One question is MDA. Steve's asking about MDA. I'm not sure what the question here is, and I don't know that MDA is a valid a Canadian option symbol, so perhaps that's a US symbol, I'm not sure. It doesn't look like it's a Canadian symbol. Eric's asking for UNS, why not show implied volatility in data and delta? We do, actually, but the whole point of this is to help users who are not familiar with these terms to avoid them, because you don't necessarily need them in order to do this work, because you typically type the data because you have to manually go searching for your options based on those things. We do that work for you. So we're searching for that delta, we're searching for that implied volatility, and we're picking those strikes for you so that you don't have to do it yourself. This does two things. Number one, it speeds up the time that it takes for you to find these trades, but more importantly, it really, when the algorithm does it for you, you know that it's not making mistakes, you know it's not straying from what you're really intending to do. So if you're short-term optimal, it will only find you short-term optimal, and if it doesn't find you one, it'll tell you exactly that. But if you want to search for the delta, you can see here at the very bottom, there's a explain strategies in Greek, so you can find the delta and all the different Greeks here if you want, but it's hidden there because it's designed to allow you to quickly find this without having to search for it manually. Eric is asking the red alert that you pulled up. So that's only for if you click on a symbol and we couldn't find you a cover call based on your particular settings. So I think one of the examples for this was ENB. Yep, so on ENB, as you can see, I tried to search for a cover call based on my short-term optimal settings, and it couldn't find me one, so that's why I get this red alert. It's automatic, so you don't have to know you don't have to go searching for it. It just automatically pops up when we can't find you anything. And lastly, Steve's asking, what are the fees? The great thing is this is free of charge to you because the TMX is subsidizing this cost. For those of you that don't have it, you can go to OptionsPlay.com/TMX. This will give you the sign-up form for how to get OptionsPlay free of charge for Canadian derivatives. Again, this is free of charge to you because the TMX is subsidizing this educational cost for this platform for you. So if you don't have it, highly recommend you to go to OptionsPlay.com/TMX in order to sign up. Lindsay's asking, is the best way in a registered account to generate income to keep using cover calls? Doesn't seem like there are other options out. I don't know if the rest of the message got cut off there. So cover calls is by far the most viable, or not the most viable. The cover calls is by far the most popular strategy to generate income on a portfolio. Like I said, one of my favorite strategies is selling short puts. So cover calls, you can only do them on stocks that you already own at least 100 shares of. So some of you may not have 100 shares of a stock, or maybe you don't own a stock at all. You can still generate income using short puts. There are more advanced strategies. If you're a more advanced trader, you can sell call credit spreads or put credit spreads. So there's lots of different ways of generating income. Cover calls and short puts just happen to be the two most popular ones. And because this is a relatively simple webinar and we're geared more so for beginners, we're starting out with the beginning strategies. There's a question about for the U.S. market. So what we're showing you today is free of charge for Canadian markets. If you're interested in trading U.S. listed options, you can go to OptionsPlay.com, OptionsPlay.com/income, and you can sign up for the U.S. version. So for those of you that are interested in trading U.S. stocks, you can go to OptionsPlay.com/income, and what that gives you access to is the same tool that I showed you today with U.S. securities. And what we do have as free special offer for those of you that have a TMX account is that you'll get a discounted rate for that. It's only $40 a month or $400 a year to access OptionsPlay for the U.S. markets. I have a question here from Neil saying, will there be future events to go over income spreads, both put spreads, etc.? Absolutely. So we actually have another webinar coming up in a few weeks, specifically on directional type strategies, both debit spreads and credit spreads. So we'll cover that on that specific webinar. This webinar was just specifically for income strategies, selling cover calls, short puts, but we will have a separate webinar for that, for directional strategies coming up. Any other questions? If you have any questions, feel free to send them into the chat window. I have one question regarding the raw return. Let's go to stock like BMO. What is the raw return yield represent? Great question. So the raw return is simply how much premium you're getting in exchange as a percentage of 100 shares of the underlying stock. So BMO is right now at 96.80. So to buy 100 shares of that stock will cost you $9,680. And what we're doing is simply saying how much is $25 out of that $9,680. That's what the raw yield is. So you're getting $25 over the next 24 days, so approximately $1 a day, if you will, and that yields out over the year to about 3.93%. So the annualized yield is just taking what you're currently getting over the next 24 days and annualizing that. So if you were to sell these cover calls the full year, month after month, you should expect your total yield to be roughly 3.9%. But the raw yield tells you how much you're actually getting over the next 24 days. And again, the one last question is to summarize, OptionsPlay is free of charge for Canadian markets and $40 a month for US markets, and you're absolutely correct. For the free Canadian version, you go to optionsplay.com/TMX. That's how you get the free Canadian version that's subsidized and paid for you through the TMX. For the US version, you go to optionsplay.com/income to get the discounted rate of $40 a month. You have to go to optionsplay.com/income in order to register for the US side with the discounted rate. Any more questions regarding anything that we went over here today? You're welcome. I hope everyone has found this webinar useful. This webinar is recorded, so once we are finished with the recording, we'll be sending this recording out to everyone probably by tomorrow at noon. So you'll be able to receive or review the information and watch the webinar again as you're at your leisure. Especially if you have the platform up during the day, you might want to have the webinar next to you so you can go over the things. We went over a lot of things, so definitely take the time out to review what we went over today along with the platform, and I hope everyone has found this useful. Thank you very much for attending this afternoon. We'll be back in the next few weeks to do another webinar on trading strategies with directional strategies. So if you have a bullish or bearish view on a stock, how can you take advantage of it? We'll show you how you can instantly find strategies just like we did today with income strategies. So again, thank you everyone for attending this afternoon. I hope you found this useful, and I'll see you guys in a few weeks.